Hey everyone, welcome to this week's episode. In today's episode, I'm going to get into something very interesting, and it's the 18.6 year land cycle that a lot of people don't know about and some people do, but it's quite widely spoken about in the market. Now, a bit of a celebration here. It is actually episode number 100. So first things first, I just want to thank everyone for watching. I really do appreciate your support. Look, whether you disagree with me or agree with me, I still really thank you for watching. And I wouldn't be able to put episodes out like I do without everyone's support. So thank you for that. But look, in today's episode, I'll get into a few things about the 18.6 year land cycle. And that is firstly, what it is. Secondly, whether it's real or not. Thirdly, how to navigate it. And then finally, the best regions to buy in. So look, really the 18.6 year land cycle, all it is really a theory about real estate markets that follows a pattern that they go up for 14 years, then down for 4. Now that includes a mid-cycle slowdown and also a winner's curse phase just before the crash. Now, this itself is quite heavily supported in markets like the US and America, and that's simply because they're much older markets and they've got much more historical context to them. Now, in Australia, it is very heavily debated, mind you. So there's a lot of people that completely pretty much deny this. There's others that agree with it. But really, within the cycle itself, this is what it means. So really, look, a little bit about it is there's a few key stages of the cycle. So after you've had a major crash, you basically have a thing called the recovery phase. So you can see that in this graph here is years 1 to 7. Now, within that, before you hit the explosive phase, you hit a thing called the mid-cycle dip or mid-cycle slowdown. It's commonly referred to as, especially in Australia, as the mid-cycle slowdown. So after that, then you follow up with a thing called the explosive phase from years 7 to 14, which by the end sort of stages that, particularly the last 1 to 2 years. And it's not shown in this graph here, but it is genuinely within the last 1 to 2 years. You've got a thing called the winner's curse phase of the explosive phase of the cycle. Then after that, you enter the recession phase. So that's after the peak of the market. Basically what happens is you go into a phase where the market just returns and it actually has a bit of a correction. Quite common in a lot of major markets to see stuff like that. I mean, in the US particularly, that's why this is very common there. So that's the stages of the cycle anyway. That's really what the 18.6 year land cycle is. So look, big question that everyone asks, especially in Australia, is the cycle real itself? Now, where I want to start with is it somewhat is. And why I say that is because without a doubt, if you go into the data, and especially if you go into somewhere like share market economics, who's really the sort of, should I say, theorists of actually making this cycle, they do break it down very well into showing the historical, should I say, cycles of land. And you can see and this goes right back for literally more than 200 years. So you can see on the left here, just public land sales, and that's going right up to literally, post World War I, just before World War II. So you can see how they kind of run in cycles there. And then they even show you after the dollar's taken off the gold standard there, what's kind of going on here. So dollar's taken off the gold standard kind of in the early 70s, so 71 to be exact. And you can see kind of like there, that's in the US, mind you, and you can kind of see there just what's kind of going on, and they're picking out all different parts of the cycle here. So look, I'm not going to be someone who discredits them completely. It is, they do have very sound research on what they say and what they're doing. So, it is definitely somewhere that something I consider to be somewhat real. Now, the only thing is just in Australia, it is somewhat delayed, these cycles, and I genuinely would tell you it would be probably somewhere between 2 to 3 years, plus or minus either side. Now, markets definitely run in cycles, don't get me wrong, and there's no doubt about that. You can see just in this graph here, property house price cycles, and you can see kind of where it's been slotted in here. Now, it's not true to a T because, you could argue in Australia, yes, they say 2007 was the peak, and then they say 2010's the recovery. To be honest, in Australia, it was 2008 to 2009 where it was. Then it picked straight back up. You could argue also 93 pretty much right to 97, 98. It was pretty flat right, pretty much right then. It didn't really do that much. And they're saying the recovery was in 93 here. So look, these numbers are not true to a T, but there's definitely elements of truth to this, because it does run in a cycle without a doubt. Now, what I'd say, though, is with that, just to show everyone a little bit more data to give everyone an idea of this actually having quite a bit of merit, I'll tell you right now. So this has been written about from these guys for, like years and years and years and years. They haven't made this stuff up pretty much overnight. It's been written about for a long time. These market curves have been spoken about for a long time. And this is an actual graph of where they're predicting things to kind of go. So you can see here, to give everyone an idea, the extreme low prices there are kind of in the darker orange on the years. The solid prices breakout is in the light green. Then you have the minor panic and minor panic bottom, which is the mid-cycle slowdown. Your stock prices going up basically there are, which is your explosive phase, are in the yellow. Your light orange is when it starts to panic. And then basically there, what then happens is you sell off, well, not your sell-off, sorry. You have a minor panic, then you have the bottom of the market, the slowdown. So, sorry, this is still in the explosive phase. And then you've got also the real estate top in the dark red, then the actual very top in the actual light blue kind of color, so the aquary kind of color. Now, if you just want to dot your I's over some of this, so you can see here they've done pretty much a 1989 peak, a 2007 peak, then they've got a 2026 peak here. Now, to the American market, that is actually fairly accurate, and also the actual extreme lows are also fairly accurate. They're quite close to it. The mid-cycle slowdowns as well are also quite close to it. So I will give credit to this where it's due. It is very, very insane that they're getting numbers out like this that are even if you're within of markets for like 20 plus years, and this is like 50 years of data, mind you, to be accurate within a couple of years is pretty insane. It is pretty much incredible that they've got stuff out like this. So there's definitely merit to that. What I'd say about the Australian market to relate it to the Australian market is that we don't exactly correlate with the US for a number of reasons. I will get into that shortly, but you'll see with some of these like lows and some of these, peaks, to have 2007.85, that is really hitting 2007, 2008. So, really that is showing that it's very close to what happened in Australia. This is almost to a T in America that, even if you think of the mid-cycle sort of slowdown, should I say, being right from, I'd say, your 2020s to 2021 or 2018, really there. COVID kind of happened around that period. And you could even argue before COVID, there were markets that were excellent buys in that period and, did definitely show that. You could also argue the same kind of even in probably some parts of the 90s. So especially, I'd say probably your 1990, probably 7 or 8, where it picked up in certain markets in Australia very well. Definitely applicable. I'd say it's definitely applicable. It's just a few years out. And it's also not, it's depicting a macro market rather than a city market. So mind you, this is what they intended to do. So I'm not going to give them shit for that. It's pretty good. It is fucking pretty good, to be honest. Sorry for this French. To give you an idea, it is pretty good. What they're doing here is good. So, look, the only thing about Australia is it's very, very different. Now, there's a lot of reasons why it's very different, and I've tried to list not everyone's going to read these, and that's fine, but for people that do want to read these and go into it, these are all different reasons, and you can add probably 50 more as to why the Australian market is different. There's 3 key areas. So there's policies that increase demand, policies that constrain supply, and then government approaches and their impact. So just to give you an idea, some of the policies that increase demand: first home buyer grants and schemes, 5% deposit schemes, 1, low interest rates, government-backed incentives, guarantees, cheaper money, high immigration rates, growing population, lack of social housing, reduced government-built supply and social housing. All of that is true. Policies that constrain supply, restrictions on land release zoning, limited availability and restrictive zoning laws, over-regulations, taxes on construction, strict building regulations, compliance, infrastructure costs for developers, and governments literally shifting costs onto other people and for new housing. That's all policies that constrain supply. Government approaches and the impact. Look, focus on more money in the market, plans to inject more money, insufficient action on social housing, historic decline in social housing, political influence of homeowners, policies that benefit homeowners. All of these are things that are entrenched within the Australian society and the Australian market. Now, it's very much so an establishment kind of driven kind of thing in Australia, and it's government backed. So I know I spoke about previously basically what kind of, in Australia, should I say, is going on and why it can't really go down because of what's happening. And a perfect example is a government intervention and their approaches, as I mentioned here, and I haven't even mentioned that in this. You could add us, as I said, 50 more things to this. You could add shitloads more to this. But anyway, what I'd say here is look at the 5% deposit scheme. The government is about to be the biggest underwriter in lenders' mortgage insurance in the country. They're basically about to be the biggest underwriter. Now, as I said to you previously, when a government gives something out, they can never take it back. For those that don't believe me, read a book called The Toxic Charity, and it's about stages of entitlement and basically that people become dependent on entitlement. So the reason the government can't take that back is because once the government gives it out, if they take it back, they become the enemy of the people, hence they lose votes. So as of literally in a couple of days' time, I kid you not, they are literally going to become the largest underwriter in the market, and they cannot reverse that because if they do, they will lose votes and hence lose the election, which is not what governments do. So Australia is a very different market to other markets. Don't get me wrong, it's not necessarily for the best of everything, but it's just the truth. And knowing this, you know how to move. It's as simple as that. So look, as I said to you, this 18.6 year cycle, give credit to it, is very, very good. It is done with great context and all that kind of thing. Just look at how the market, micro markets within markets, so it's not the whole Australian market. Look at cities, look at suburbs, and also look at Australia as a whole and what policies are in it. It's not the same as US or UK markets, very different. So just keep that in mind when looking at the 18.6 year land cycle. Let's get into how to navigate the 18.6 year land cycle. Now, as I said to you previously, it's not something I agree with to a T, but markets definitely run in cycles. Now, look, that itself saying there is definitely some credit to a lot of this, as I said previously. And I mean, really, timing in this cycle does matter, and it does matter to even the cities we're talking about. So I'll just show you something here. So this is basically how the market kind of works. So first things first, you've got good times to buy at different stages of the cycle. So you can see just here in years 1, years 7, and also years 18, which is actually the start of year 1 technically, or 0 again. Those are great times there to buy. Now, it's not the same for all cities, of course, but they're definitely great times to buy in those markets. Now, on the contrary, there's also good times to sell or otherwise refinance and pull equity out. So those times are obviously your mid-cycle dip. So that's at the very peak. It's usually year 5 or 6 in the first recovery phase. Pardon me. And it's usually year 13 or even late 12 to 14 of the actual major explosive phase. So that's kind of what you want to do with this cycle. Again, it's not true to a T, but that's the fundamental sort of macro thing that you want to do in this. So timing is definitely important. Now, in Australia, just remember, different markets have different cycles. So this is a key part I'm getting into. So Brisbane itself has a very different cycle to Sydney and Melbourne. So does Perth, right? Now, generally, Sydney and Melbourne correlate somewhat. They're not exactly correlated. Actually, recently, they haven't been anti-correlated or going against the correlation of each other, but they haven't been correlating as much lately, but generally they do over the long term. However, Brisbane and particularly Perth as well, the correlation of them generally go against Sydney and Melbourne. So easiest way to show you this is just look at kind of what's happened in Brisbane with it booming kind of, between the years of 2000, kind of late 2007, right? Through to kind of like, I'd say right through to probably 2012 or so. It did actually very good numbers in that time. It nearly actually doubled in that time, whereas Sydney was very stagnant. Though Brisbane was stagnant in 2012 right up kind of to about 2019, although Sydney did some incredible numbers. Now, yes, since COVID, it did go up since then in Sydney, but I'd argue that was because with a very low interest rates, and it's kind of like a dead cat, not dead cat bounce, but a cat kind of bounce, I call it, because if you flood more money in the system, it will go into the market. Now, it didn't do as well because it was a different stage of its cycle. So you can see here just they don't correlate really at all. They correlate somewhat, but not very much. They kind of go against each other in terms of booms and busts. I wouldn't even really call it a bust. I'd just say a cycle slowdown in Australia. So markets do run in different cycles, to be transparent with you. Now, look, as I said previously, different markets you buy at different times. So I did pick out the times when to buy in the first actual slide of discussing how to navigate this cycle. I'm actually going to tell you where to buy at different stages now. So in your actual recovery phase or post your actual recession phase, so it's in year 0 or year 1 especially, in times like that where you've had very slow markets or very poor performance in a key market for a long time, that's when you want to buy generally your major cities. So in your early years, it's definitely your larger cities you want to buy in your major cities. Now, I've pointed that both out here, and you can see on both sides, because the one on the left is technically the start of the one on the right, so it's just because it's not an ongoing cycle. But the minor cities are actually better to pick in the mid-cycle dip, because generally your major cities do very well in the first stage of this cycle. Now, this is quite accurate over the long term, and I'll explain to you why in later parts of this. But just keep in mind, all markets are susceptible to cycles. So what do I mean by this? Now, we've been through the property clock before. I've been through a lot of other things before, and I've explained this to people in great detail. The reason I did that is because this is kind of what happens in all kind of markets. So as you can see, if you want to chuck on the property clock, you can, but I've made it a little bit easier for people here. So you got clearly a slowdown, a slump, recovery, and boom. Now, if you want to give everyone, if everyone wants to understand how it works with a property clock, slowdown's basically your downturn, slumps your stabilization, recovery is your upturn, and boom is your boom phase as well. So that stays the same. That really light sort of green there is kind of like lime green is kind of your winner's curse phase, to give you an idea. So that's kind of where things are at in terms of a property investment cycle. I'd say at the bottom buyer's market, that would be buyers / refinancing market there as well, because you can pull out equity and do very well with it and chuck it into a better opportunity. So look, as I said to you, all markets are susceptible to cycles. So just remember there are better cities to buy than others in certain points of the cycle. Look, let's get to the best regions to buy in now. Now, it's not specifically buy anywhere because this area is that, this one's another. Really, what I think is going to happen is, previously I did show people the actual timing of when people thought it was going to peak. The actual graph there but the actual property share market, economics, and most of the other people that are predicting it said that it'd be 2026 would be the peak of the market. I don't think that's going to be the case in Australia. I actually think the market peak, as you can see here in red, will be 2027 to 2028. And the market recovery will start between 2028 and 2030. I think it will be somewhere between 12 and 18 months, that recovery, to give you an idea. And when I say recovery, it'll probably correct for 12 to 18 months is what I think. And that's a macro market of Australia. Some markets that I will mention soon, I think may correct may be only stable or correct very little. And they will indefinitely be great performers in the future. But if I'm to be transparent with you, I think it'll be somewhere between 2027, 2028, and probably around 2028 to 2029 where it starts picking back up in certain markets, but other markets will be shot. They will go silent for a number of years. But that's kind of what I mean by my actual predictions about why where the market is and best regions to buy in. So really, your worst markets, to be transparent with everyone, without question, Perth, Adelaide, Brisbane, and surrounds. I'll put an asterisk around Brisbane and surrounds, and it's simply because some pockets of Brisbane will not be affected as badly as others, particularly inner north and inner east. There are still some markets there that I can see doing quite well for a number of years to come, and it's especially because of how restrictive the land is and where all the infrastructure and wealth is in terms of the Olympics. But the macro market of Brisbane will be shot in this time. It will go silent for a number of years. Perth and Adelaide, I cannot tell you how bad of an investment both of them are really right now. I wouldn't be buying them right now. They might do very well in the next 1 to 2 years. They may do 15 to 30%, don't get me wrong. But once it goes down, you're in for a number of years of a slowdown and possibly a little correction, quite a correction as well, particularly in your exurb kind of suburbs. So particularly in those suburbs where your idiot kind of, sleazy salesman buyer's agent or salesperson just tells you, yeah, buy this new estate in the middle of nowhere in Perth, like in somewhere like, Baldivis, somewhere like Eglinton, Alkimos, anywhere like that. They're going to be very, very badly affected in this cycle. Same as Adelaide. I mean, if you're going to those new estates north of Elizabeth and kind of like things like areas like that, good luck to you. Like, you're going to be very badly affected by things like that. And people in Brisbane who aren't in the inner east or inner north, I mean, if you're like in some new estate towards Caboolture, if you're, in some new estate right down south past, Inala and all that kind of thing. The ones that are literally right towards sort of, the Gold Coast hinterland, those estates down there, you are going to be very badly affected in this. It's not the market you want to buy in at the moment. Now, on the contrary, the best markets really to buy in, no kidding, are, I've mentioned this in the past and I mentioned again, without question, Melbourne is your number one market to buy in. I'd probably argue, this is in no particular order, Melbourne, Sydney, Geelong, Newcastle, Central Coast and Wollongong. All of these markets are going to do quite well in the preceding years. I actually think Melbourne, as I said, it will be by far the best performer over the next 10 years. I expect Melbourne to go up in the next 2, don't get me wrong. I expect it then to probably slow down after that for a year or so. I am predicting that, but the slowdown is going to be tiny. It might go down. It might even stay. It might go down not at all. It might only slow down and still grow at 0 to 2%. The worst I think it'll do is maybe might go down by 3%, but I actually think it'll probably only go down by 0 to minus 2%. But in the 2 years from now, I expect it to do somewhere around 15 to 25% growth, to give you an idea. And then after this, when it starts to pick up, it's going to really, really take off into a large, really big boom phase for a couple of years where it'll catch up to its long-term Sydney average while Sydney's still going up. I think Sydney will do reasonable numbers in this as well, and Geelong will too. But Melbourne in particular, in this time period, it is going to, I kid you not, it's going to go up while Sydney is going up, and it's also going to recorrect its long-term average. So Melbourne is supposed to only be about 20 to 25% cheaper than Sydney in terms of for a detached house. That number in good suburbs at the moment is 60%, and I'm expecting Sydney to go up in this period as well. So the way I'd say this is, I'd say Sydney is your car that's just warming up its engine. I'd say, mind you, Geelong is the car that's already started the engine, but Sydney goes slower than Geelong. Melbourne is literally the Bugatti that's literally 2 suburbs away, right? That has only just started its engine, is just warming up, and is kilometres behind, but is going to basically catch up to all these other cars that are kilometres ahead of it. That's for car lovers. That's how I'd basically describe the market. Geelong and Newcastle particularly, they will do well as well, and it's because they're particularly Geelong as well, and I would say Newcastle too. Geelong will probably outperform Newcastle in terms of percentage basis in this time, I think. It's because of its price point and also the part of the market cycle it's in is a little bit better. Newcastle will do very well though as well. The supply is so restricted in Newcastle and there's so much money going to it, and there's even developers, flippers, everyone flocking into there. It's going to do well. Central Coast and Wollongong will also do well, just simply because of the part of the cycle. They won't do as well as the other markets up above here. Some suburbs of the Central Coast that I mentioned will, and same as Wollongong, but these are a bit more, they're not kind of as metro as your Newcastle or Geelong markets. Newcastle and Geelong particularly are truly metro markets. So they will definitely do better in that. But without question, no doubt, the best pick of the market is unquestionably Melbourne. It's your number one pick, and then probably followed by Geelong closely. Your number one pick, that is the best market to buy in right now, and the best market to buy in long term as well, without question. Let's get into also some other markets that aren't bad to buy in. And I've just put this in here as your later best markets, and it's kind of in your like lighter green. And those markets are Hobart and Darwin. Now, yes, Darwin has gone up quite ridiculously in the last probably 6 to 12 months, no doubt. But really, these markets are definitely going, in my opinion, definitely lagging these as well. Look, Darwin isn't really somewhere I buy. It just doesn't have the right fundamentals for the economy there. Hobart's okay, but I mean, it's definitely one where I think you're going to have to, sit on for a little bit longer and expect some growth. I'm expecting to actually do fairly decent numbers over the next 10 years, but I expect the vast majority of that growth to happen definitely within the latter part of the next 10 years. So definitely within probably years 5 to 10. I expect it to be a little bit slow and flattish for probably the next 5 or so years, maybe plus 1 or 2 years onto that, either side of it, but definitely towards the latter end of the next 10 years, it'll do well. So that's where the markets are kind of at. As I said to you, this follows pretty much my property clock that I've been showing everyone. I've just related it to your 18.6 year land cycle here. Definitely do not buy in Perth, Adelaide, and Brisbane, except if you're buying in Brisbane in the inner north or inner east and you get it for the right price. Those are the only markets I can kind of see doing probably 25 to 40%, should I say, growth, and they're going to dominate the parts of the cycle. Some will do actually higher than this, some properties, but most of them won't, and these new estates are going to be really, really shot by this part of the cycle. But market recovery areas, which is pretty much exactly what I was saying in my property clock, Melbourne, Sydney, Geelong, Newcastle, Central Coast, Wollongong, without a doubt, Melbourne and Geelong. Melbourne is by far your number one draft pick. Geelong is a close second. And other markets will do decent, probably Hobart and Darwin. Again, I'd pick Hobart over Darwin, but I'd probably pick Geelong over Hobart first. So that's kind of where I'm at. That's my episode. Look, it has taken me quite a bit of effort to go into this. I've done it through intense analysis, quite intense debate between a lot of people in the industry that I respect, and I've kind of actually formulated this based on what I think, based on what the data says, based on what a lot of other people with a lot of experience in this industry actually say as well. A lot of people, mind you, do agree with the actual sort of analysis that people know that markets go in cycles. Not all people agree with the 18.6 year land cycle, but they do agree that there are stronger parts of a cycle that perform in certain cities and others that perform well in others. So, they pretty much, even the people I spoke to who kind of disagreeing with the cycle still did see the fundamental idea of this happening. So I actually think it is probably 70 to 80% true. The parts that aren't true in Australia are that you have major crashes like you can in the US for the moment, because it's underwritten by the government. That's the reason. And the second thing is it's also out of line with where the exact numbers happen, but it's still pretty good. So respect it, people. I actually quite like it. But look, that's my episode for today. Look, I hope everyone's enjoyed it, and it has, as I said, taken quite a lot of effort, intense debate, and should I say time to get this together. And if you're someone who's really serious about getting the market and you're looking for a genuine buyer's agent who wants to take care of you better than anyone, I strongly suggest you reach out to me via www.compoundinvest.com.au/inquire. What happens here is you can book in a time with me. I give you a phone call. It's for 30 minutes generally, give or take a couple. And what we do is we discuss what you're looking to achieve. I'll give you some options, and basically we go from there. Now, for people that aren't serious about that right now, or might just be kind of flailing and they don't know what to do, I still say you should probably reach out, because having the right strategy and understanding the market well is very important. It's probably more important than the purchase itself. I can't tell you how many people I speak to on a weekly basis who are very upset either with service they've got, they don't know what they're doing, they have a strategy that doesn't match what they want to achieve. Perfect example, you meet someone, got 3 properties, one in Albury, one in Logan, and then one in, Shepparton. And it's like, well, I'd sell all 3 of them and maybe buy one very good one or 2 quite good ones instead. Now, over the long term, that's just going to help you out, and it's just going to set up your financial future. Buying in crap suburbs does not help you long term. It may help you over 2 to 5 years. And a lot of people, because we're only 5 years since COVID, think think they're great investors and they're bought in shit areas that are just going to shit the bed when things come to a roost. And that's exactly what I was talking about in this, actual land cycle. And I talk about it all the time in my actual episodes. So if you're someone who actually wants proper advice and actually get the proper results in the market, I strongly suggest you reach out via www.compoundinvest.com.au/inquire. I thank you for watching this episode and I look forward to seeing you in the next one.